Hi friends, I am discussing currency options when the question is having indirect quotation. So let me discuss an example to explain question number 40 in study material, which is also a currency option question which contains indirect quotation. Okay, first of all, we have to consider a direct quotation. That is, today the price of dollar is 60 rupees. So we are discussing the risk exposure from the point of view of importer. Okay, so today the price of dollar is 160 and tomorrow it is becoming 65 will be the risk to the importer. Means in the case of direct quotations, increase in prices will be the risk to the importer. So accordingly, if the prices are increasing from today to tomorrow, the strategy will be the holding the call option. Okay, it is in the case of direct quotations for the importer. So let's discuss the same analysis from indirect quotations point of view. So we have to convert these two prices into indirect quotations. So $1 equals to 60 rupees. If we express this quotation into indirect terms, that will be 1 rupee equals to $0.0167, and tomorrow $1 becoming 65. We have, if we express this into indirect form, 1 rupee equals to 0.0154. So now here, if we see the price of rupee becoming $0.0167 to $0.0154 is the risk to the importer, as we have directly converted the risk involved quotations to indirect form. So the risk remains same. Means in the case of direct quotations, increase in prices will be the risk to the importer. The same quotations are expressed in terms of indirect form. Here if we see, fall in prices is the risk to the importer. So accordingly, what we have to choose whenever there is a fall in prices, if the quotations are in direct form for the importer, that will be holding the put option. So this will be the simplified version of solving question number 40 and question number 33 in study material. Okay, now let's discuss question number 40 in study material, which is also having a currency option, and it is also containing indirect quotations. So here the person is UK importer and he requires dollars 364,897. I mean $364,897. So his own currency is pounds, his foreign currency is dollars, but the given quotations are expressed for his own currency. Means how many dollars, how many foreign currencies are required for one home currency. That will be the definition of indirect quotation. So if we see this quotation in the question, it is given that 1 pound equals to $1.70. Means it is clearly the indirect quotation. So now what we have to do is, we have to convert the given indirect quotation into direct quotation. So that will be $1 equals to pound 1 by 1.70. It means $1 equals to pound 0.5882. The same indirect quotation, if you convert it into direct quotation, it will be $1 equals to pound 0.5882. So now what will be the risk to the importer? As we have converted indirect quotation into direct quotation, whenever there is a increase in prices, means if the outflow in pound, that is his home currency, if the price of $1 is greater than 0.5882, that will be the risk to the importer. So accordingly, let us assume a price quotation which is greater than the 0.5882. So I am assuming $1 equals to pound 0.6005, which is greater than 0.5882. So this quotation, if the price of $1 today is increased from 0.5882 to 0.6005 in tomorrow, that will be the risk position to the importer. So now let us convert this risky quotation to indirect one. So now if we convert this direct quotation to indirect form, that will be 1 pound equals to $1.60 1.6653. So now we are having comparable indirect quotations, as one is given in the question and other one is we have constructed. Okay, now we are having two indirect quotations which contains risky position to the importer. That is one which is already given in the question, that is today's price, that is 1 pound equals to $1.70. So if we analyze the other indirect quotation with this given indirect quotation which is already given in the question, that means the prices are falling from 1.70 to 1.6653. So if the prices are falling from 1.70 to 1.6653, that will be the risky position to the importer. The same risky position, if we compare the previous two direct quotations as we have created based on the risky position to the importer, that is if the price of dollar is greater than 0.5882, then that will be the risky position to the importer. So the same quotations are converted into these two indirect ones. Now we have to analyze and accordingly answer. So here fall in prices indicates the risky position to the importer. So today the price of 1 pound is 1.70, but tomorrow it is becoming 1.6653. Means whenever there is a fall in prices, what is the strategy for the person? That is put option. Means holding a put option is the correct strategy for this kind of indirect quotation if this is the case of an importer. So now if we solve the question by choosing the put option, the outflows in the pounds are these. That is through put option we have outflow of pound 2,12,500 and the balance portion which are covered in put option. Other than the put option, there will be some dollars remaining, and those dollars has to be covered through forward contract. And the equivalent outflow today is pound to 2,359 rupees. And also we have to pay the premium for purchasing the put option. That will be requiring pound 13,063 rupees. Sorry, pounds 13,063 outflow of pounds. And as we have to pay this pound today for purchasing the put option, accordingly we have to borrow and have to pay this premium. So for borrowing 6 months we have to pay the interest. So all these four things giving a total outflow of 2,28,379 pounds. So this is the logical point or a tricky point, whatever we call. This is the summarized version of understanding a question which contains indirect quotations for currency options. So we can convert these direct quotations into indirect quotations and accordingly choose an option, or if the question is having indirect ones, we have to construct direct quotations for knowing the exact risky positions of the importer, and after that we can convert the direct quotations into indirect quotations. We can say whether there is a fall in, whether there is a put option to be chosen or call option to be chosen. That's it.